Well, I'm going to the city and I'm gonna do a slimmy show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward to what might happen in the next week, and hopefully lots of great ideas and opportunities for you throughout the show. Well, this was another week where the stock market kept moving strongly to the upside. It seemed like buyers came in no matter what happened, as early dips a lot of times during the week as the day started then just brought buyers back in the market. Even a chaotic week for President Trump couldn't get in the way of the market, nor could comments out of Janet Yellen, who said it's unwise to wait too long to start raising interest rates. That just sent the bond market down, but the stock market took that as, well, economic growth is coming, and the bids just kept coming in. And the NASDAQ just won't tick down at all, really, even on Friday when the market is correcting a little bit, but the NASDAQ is still moving up. Core inflation rate came out, up 2.3%. Well, that's finally gotten above the Fed target, but that doesn't seem to matter at all. They've only raised rates 2 times in the last 9 years, and yeah, they come out with tough talk, but simply no action. And I think it's ridiculous that to this point that's all we've had is 2 increases in interest rates. Stock market, the S&P 500, NASDAQ, Dow Jones Industrial Average all up 1% or a little bit more for the week. The Russell is the one that's struggling by a little bit, and we'll call it about unchanged as we get towards the final hour here on Friday. Bond market, it was a slightly down week for the bond market, and it was pretty strongly down early in the week, but then Thursday and Friday brought a rebound after that big hit to the downside. Dollar moved up into our sell zone and then reversed down sharply, so that worked out really nicely, especially for one trade that we put out inverse to that, which was a long Japanese yen, which worked out really nicely. So the dollar small down on the week. The yen got a nice pop on the week. Gold, of course, moves opposite. As the dollar moved down, then we saw gold move back up, and that really was a small week, though, for the metals, as they seem to just be gyrating around with the rest of this stuff like the dollar. The oil market, very choppy week. Inventories up, and the week in the oil market was small down. The products really are weaker than oil is, and natural gas really is struggling, as that one has really gotten pummeled. It's just been a number of weeks that we've seen it move down here like $1, so a huge crush in the natural gas market. As the inventory number came out there, a draw, but it wasn't as big of a drawdown as they expected. This is traditionally a week where you get big draws in natural gas, and you only got a small one, so that got the market upset. Natural gas got hit, and overall energy markets sloshing around, pretty much trendless at the moment. The shorts here are agonizing, and we're getting a lot of emails telling us, how much they're struggling. Same thing for the wannabe longs in the market that are wishing that the market could dip and they could buy it. And most people that are contacting me are saying, well, how far can this market go to the upside? I'd like to make some comparisons now, do something a little bit unusual. What I did was I went back and looked in history at the time time periods that had similar market trading to this. So what would make it a similar market? It would be an extended bull market, one that somewhere in the middle had some kind of a correction and then took off again when the bull market was already old. And that's certainly the characteristic of the bull market we're in now. So going back since the Depression time, there are really two major market cycles that look a lot like this. And I want to share those with you and make a comparison to present time, and then maybe we can draw a conclusion off of that. The two bull markets that we're going to look at are the ones that ended in 1962 and the ones that ended in 1987. Now, 87, I know you're all thinking you know how that one ended. We're going to take a look at those. We'll bring up profit charts, which is a chart that I don't often look at, but it's got great long-term information on there, so that's why I use it. And we're going to start out with this bull market cycle that was in this area of 1957 to 1962. So here you can see that period in here, 1957 low, and what was really a long bull market. So here's your low right in here, and that came off of another long bull market in here. You could see that this bull market ended 51 months off the previous one. The average cycle is about 53, and this is the one we're looking at, 1962. So here's the numbers that we're going to compare. First of all, this was a very long bull market. The next thing we're looking at is that it had an intermediate correction in the middle, right there, you can see that, and then took off again. So what we specifically want to look at is the last leg of the bull market, and that is how long did it last and how far above the previous peak did it get. So those are the things that we're comparing in here. So this was a very long bull market. The final phase, this long one right in here, was 13 months long. It achieved about 7% above the last peak. That's not a big amount right there. But the last rally in there was a long rally, 13 months, and it was 32% off of the corrective bottom. So 13 months, 32%. I want you to remember that. Of course, after that ended, what you had was a bear market in here that lasted about 5 months and dropped 28%. So you believe me that there was a 13-month rally in here and everybody was saying, wow, that is a long rally, and how far can they go? Well, let's switch this over now and look in the period as I roll forward in time, and we're looking at the 1987 bull market. There you go right there. So we're going to look at similar occurrences. Let's just bring this in a little bit so you can see, and that is a bull market that was very long. This one was extraordinarily long. That had an intermediate correction that really wasn't that deep, but it lasted for a long period of time, just like the one in 1960. And then what happened was that you had an 11-month rally right there. So this is a very similar pattern. Long bull, correction right here, and a final move up of 11 months right there. The final move was a total from the corrective low, incredible, of 59%. 59%. And it had achieved a total of 42% above the corrective high right there. So you can see that this was an extraordinary market. And because it lasted so long and went so far, it had a 3-month crash of 40%. And you can see that right there, the crash of 87. Historically, the longer the bull market and the longer the final phase and the stronger the final phase, the steeper the downside correction. Am I scaring you at all? Well, we actually have a very similar occurrence right now as I move forward to the present bull market right in here. So this bull market, I have to actually go further out for you to see that right here. Let's just lengthen this right at this point. This bull market is extraordinarily long. It's longer than either of the two that I just showed you. Here's that intermediate correction right in here. Now remember that 1962 lasted 13 months, 19 87 lasted 11 months. 1962 was a 32% gain. 1987 was a 59% gain. And right now, what do we have? 12 months so far off of the corrective low with a 32% gain. It's almost exactly what 1962 was. And not quite what 1987 was, but still you could see the extreme. And as a matter of fact, we have achieved a level above this corrective high by 20% already. We're looking, of course, at the Dow Jones Industrial Average. So there you can see what are really important comparisons in the market as the market now is reaching those level of extremes that we saw historically in those other two markets. I thought you'd be fascinated by that. I certainly was, to see that. If you measure this by extremes and by historical patterns of bull markets, this one is like 1962, not quite like 1967, but the duration of this rally overall is longer, and the duration of this final phase is about the same. And what I can extrapolate out of that, and I'm, normally I don't do a technical picture right here, but that is to me saying that, well, once this rally phase is over with, that following decline is going to be extraordinary. Something to remember. I have been calling, based on my longer term analysis, for a low of a extreme correction sometime in the summer, June to August. That would mean it would probably be peaking pretty soon. Wanted to show you that because I think that is some very important information. I hope you like that. Write me an email if you're watching this on YouTube. Click on YouTube and give me a comment on there, and then make sure you hit a like, or if you don't like it, you could put a thumbs down. And I can't imagine you would do so, but I thought that was good information. So that is a look at major bull market formations, and one that might be signaling trouble right now as this has reached an extreme. All right, now let's take a look at what happened to this market this week, as we have had buyers come in almost continuously, and that has been a trend that I'm going to show you right now has just not stopped. So here is our hourly chart of the E-mini S&P with the gray areas, the areas that are overnight, and the white areas, which I have green ovals in there right now to highlight, are the ones that happened during the day. So what I really want you to see in here is the nature of this market, which is if I look all the way back, now I'm going to go back to the previous week right in here so you could see, and I want you to see all of these ovals. You can see every one of those, 1, 2, 3, 4, 5, 6, 7 in a row right now we're looking at right there, have had the stock market at some point in the day have a little bit of weakness, usually early in the day. This one had no weakness, and then buyers come in every single day right in here. And this is the nature of a market that is really some, almost non-stop buying in here, as here we are on Friday coming into the last hour, and the market's still doing the same thing. Just amazing action that we're looking at in here, in this, which is an up week. So basically, you have every day looking pretty similar, but the news background wasn't really the case, and other markets didn't really do the same. You can see that up day on Monday, you can tell that there was some stimulus in there by just absolutely no buying coming in right there. And bonds and gold moved down on this day, but stocks were strong all day. And OPEC, well, they came out and said they're 93% in compliance on a deal. They're usually cheating a lot more on the deals by then. And I think oil is going to have a better time of it coming up pretty soon. Tuesday, well, Greece in trouble again. World markets stalled, but the U.S. market opened down and then took off again on the upside. The PPI was really hot. Bonds moved down for the second day in a row, and Janet Yellen came out and said more hikes are coming, but that did not stop the market at all. On Wednesday, banks were driving the market to the upside. CPI hot at 0.6%, core year over year 2.3. As I said, that doesn't stop the market, as inflation doesn't seem to be a worry to the stock buyers. But that did make the high for the week right in there, as that did maybe get them a little bit tired. And the correction was just, if anything, modest in here that you can see for the rest of the week. But banks really, really strong and driving the market to the upside. Bonds down on Wednesday for the third day in a row, but then on Thursday and Friday get the reversal. This was interesting right in here. We got this move up late in the day on Thursday, and there were rumors around that some $17 billion fund that was short a lot of options, expiring options, got squeezed for some big losses. And so the market was down early, but then, of course, the buyers came in on that rumor, and maybe that's really true. And you can imagine that that would happen to some out there in this market that are big funds that are trying to take advantage of being short some premium. So, and Friday, as you can see, as just has been going on all week, the market moving back to the upside after some weakness. The UK, that was softer as they had some bad retail sales, and the EU zone was moving to the downside. That did bother the stock market, but the NASDAQ is strong again on Friday. And that really is keeping the market from moving to the downside in any strong way whatsoever. So that is a look at what happened during the week. Here's our calendar for the week, and don't forget that Monday is closed for President's Day. If there is any big news this week, it's going to be the Fed minutes that come out on Wednesday. And as far as earnings go, just a few of them coming out, as you can see, nothing really big. And we can see that, well, we've got some fire truck coming by here. And we'll let that get by. And now in here you could see that here's a big one, Home Depot, before the opening. I've been making the point that the eventually these brick and mortar type stores like Home Depot and Lowe's are going to start to get affected by the online sellers. We're going to see if that's true. Those earnings, I happen to be short Home Depot, believing it has a pullback coming. So that's a pretty big one right there coming out. And then Wednesday after the close, we've got Cheesecake Factory, Hewlett Packard, and Tesla. That's probably our biggest afternoon in there. So we'll see if JCPenney is ready to start to say how bad their burn rate is and how bad things are for them, because I have thought that they are really bad. So that is a look at our economic calendar for the week. And that wraps up the beginning of the first segment. And now what we're going to do is we're going to move to our best and worst stocks of the week. And here comes the best. All right, best stocks for the week. We're going to start out by looking at one that is the biggest percentage gainer of the week. Well, maybe Sears is, but we're not going to look at that one, SHLD. They're doing some restructuring, and that is going to help. They're up about 9 or 10% for the week, and I actually don't believe that that's going to keep the rally going in there. Maybe you'll get to see it tick up another point or so, but these are all of these restructurings that you've seen in Sears, JCPenney, they haven't worked at all. So even though that would be the biggest mover for the week, I'm not even going to show it, because I don't think it's going to last. But CSIQ is one I really want to look at, as this one moves up about 9% for the week. This is a very, very strong mover, and like I said, this one is on my list of the best stocks for 2017. It's mainly for me a valuation play as we look at this, as this stock, in my opinion, had made an important bottom in here. Now it's putting together a kind of an inverted head and shoulders, kind of weird one, because the neckline is kind of, well, right there. You can see as it's getting close to it, something like that. So that would say to me that it still might need a little more to break out, but look at that up week right there. You know, if there's anything I think that is helping this stock, it's that, well, first of all, they did sell some deals recently. But there is a movement to get to build the consciousness for President Trump that it's time to get some focus on alternative energy. And this one is just such an incredible value. I mean, the forward PE still around 7 in here. Look at this. I mean, a $14 stock that's going to earn around $2 in the next year. I mean, that is just incredible. And at some point, they start to look for value when they stop buying these incredibly high-priced tech stocks. So CSIQ, that one getting a very nice move for the week. Goodyear Tire is another one in here that's getting a nice upside move for the week, and I think this is overdone. And if I apply our short-term, what we call our option bias indicator in here, it's at an extreme overbought condition. Their earnings a week ago were really mixed, and this is really some crazy upside movement. So I think it's overdone, and you can see our projection in here is this right in here, that it would pull back and then have a bigger move up maybe in the springtime. But you could see the cyclical patterns in here that are really pretty nice. And this one due to pull back right in here. So Goodyear Tire up about 7% on the week, and I don't really like it. Next one we're going to look at in here is Schnitzer, SCHN. And I recently highlighted the steel stock, saying that they were all bottoming, and you can see the timing spikes that we have right in here. That says that this is the time frame that we expected this correction to end, and you could see just storming on the upside in here, and we're getting some really good action in the steel stocks. And of course, they barely can make any money, or they lose money, and it's really a lot of anticipation in this group. When we see that. So, but if we get the stimulus programs that they talk about in here, then it'll be warranted, because we'll get the upside push in earnings in the materials and the steels. But if we don't get this fiscal stimulus and these so-called shovel-ready programs, fixing the bridges, the roads, all those things, these stocks are going to be extraordinarily overpriced and then really have downward shocks. But right now, the steels are in really good shape. Let's take a look at some tech stocks in here that reported earnings and are doing, well, pretty well this week. Here is ADI, Analog Devices, and you could see in here the stair-step upward movement. Now, if you're new to our cycle analysis, these are cycle brackets right in here, and they are guides. Cycles are measured from low to low, and you can see how there is an extraordinary amount of cyclicality in here. As a matter of fact, this was a bearish cycle, then this was a basing cycle because it didn't make a lower low, and then stair steps its way upward, and now is at an extreme right over here. So we're looking for a pullback in ADI, and if we get that into March that we expect right there, we think it will be a buying opportunities. So this one beat on earnings, up 6% on the week. Cisco also up 6% on the week, CSCO, as they reported and beat on earnings. This a similar pattern. You could see we have our colored phasing in this one, whereas the green are the rising phases, the yellow are the corrective phases, and the red, which there is hardly any to see on here, is a breakdown or downward phase. There's the one right in here, right there. And this, you can see again, the stair-step upward movement getting late in this rise and coming into a corrective period. And so, we've been talking about techs being overdone and potentially other stocks being rolled into. In this case, you can see some examples of that. NTAP, NetApp, up 3% on the week and really starting to give it up. You can see the tail in here. So this is another example of that stair-step upward motion that comes off of a base being built. So this is the declining right in here. When you break down under the low of a cycle phase right there, it gives you a declining phase. That's what you got. Here's your base that was built, the upward movement in here, getting late in this cycle and then looking like it's going to have a pullback. See that tail right there? That says that it's likely overdone, and sellers came in at that level. We'll be looking for 2-3 weeks on the downside. If you look at this pattern right in here on the daily, you can see in here that our dailies all have our momentum indicator, the slim ribbon on it. So the slim ribbon is positive right over at this point. It gave you all this rally, and there is your shooting star top right there. So that's an indication that that weekly pattern we were looking at is topping and that you're likely to get some correction. One group that's really notable that we really want to look at in here are the consumers and food stocks. So we're going to switch from NetApp to look at one I don't follow. Just putting it up because it influenced this group today. Look at this one, Kraft Heinz. It gets this big up move on the week. Now it's only up a few percent on the week, but rumors came out that they were talking to Unilever, and not sure whether those talks are going to continue, but what it did was it brings some big upside moves in Kimberly-Clark and Colgate and Clorox, and two stocks that are suffering because it's less likely they'll have deals with them are Mondelez and General Mills. So the stocks that went up, KMB, you can see in here, look at that. For this kind of a stock, it's just absolutely crazy. If I had a long in there, I would sell it. Colgate, there you can see there, a little bit earlier in the move. It's only 3 weeks off of its low. This one I would buy in a pullback because I do like that when it's early in the upside move. Clorox really late in here, really a gigantic move for it in there. And I would say that this pattern in here looks like it's going to correct out over here also into late March, early April, before it then can have another up move there. So these consumer stocks in here I think have had just extraordinary moves, and I wouldn't be a bit surprised to see those stocks then give up a lot of gains, and then maybe there'll be buys after that, but just crazy up moves in those stocks. That's the best of the week of the 320 stocks that we follow on a regular basis, and now I'm going to show you the worst. All right, for the worst stocks of the week, we're going to start out by looking at TRIP, T-R-I-P. This stock moves to the downside as earnings were a big miss in there, and it gave it about a 10% break and what looks like a continuation of a negative pattern. Now, as we get our worst of the week off of there and bring our chart patterns in. There you go. So here is the chart, and there is a look at the cycle patterns in here. So you can see this was a bearish cycle right here. You see that? And then this one only got up to these moving averages and then turned down. Once you got the next rally and broke underneath those lows, it was bearish and it fell right down to this window of time that we put in here. The rally came up and now it's threatening the lows again. That is a horrible pattern, and what that says to us is that this is likely to continue on the downside way out here into June. So this is a bad pattern, and we would look for it to move to the downside again. I'm switching over to the daily pattern in here, and I want you to see the failure right here at the 89-day moving average. That often happens. You can see that it failed right here at the 89-day moving average, and there it did the same thing right there. Here's your big downside high volume gap. This is that low level right over here, which it's almost gotten down to, but the fact that it almost got down there already is enough for me to say that this is a really bearish stock. That is TRIP. Next one we're going to look at is MGM, which also missed on earnings. And this one, you take a look here and you can see a big breakdown from the multiple tops. We're going to look first at the daily chart right there. All these multiple top warnings, engulfing pattern, double star, evening star, engulfing pattern, and then this big breakdown underneath the 89-day moving average, momentum turning negative in there, and a really bad pattern. This one is suggestive, once it's getting under this 34-week moving average, that it could have a lot lower to go. We'll be looking at next support around 23 in here. So MGM, a really ugly look on a bad pattern in there, and we think really going lower. Let's take a look at materials. They moved down on the week, but actually I think they're buys in about 2 to 3 weeks. Let's look at FCX. And you can see in here this pattern, which has a big inverted head and shoulders bottom in there. Here you can see the inverted head and shoulders. Here's the measurement. That's our target for the year, up around $23 to $24. There's about 2 or 3 more weeks in this pattern. Here you can see the copper pattern that it often follows. Base metal pattern right in here, and this stock's pattern right in here. So right here is where it's likely to turn up with base metals and copper after the copper correction. FCX down on the week about 7%. I think 2 to 3 weeks and you could start loading the boat on that one. Alcoa, well, I say loading the boat, but I really mean be careful. But then when you see it going your way, then you could be aggressive. This engulfing pattern in Alcoa says it's going into a correction, but it's leaving no time for the correction. Here's the rally period, and here's the sell-off period. So we have 2-3 weeks in here on the downside, and then taking off again. Probably this area right over here, we'll call it 32, 33 is the spot that you want to be buying it as after this correction's over with. So Alcoa down on the week about 6%, but that one says to me that you should also be looking for materials, other material stocks to buy. You could take a peek at Vale, V-A-L-E also. BHP Billiton is another one that is a possibility. So materials, I think you can buy those in this next dip. Not much time. So next thing we're going to look at is AIG. This stock had a bigger loss than was expected. This is one of those stocks that I believe we shouldn't be even talking about anymore. The stock should be gone, out of business, long gone. They were really pretty responsible for taking extraordinarily excessive risks with CDSs that was part of causing the panic. The government bailed them out because they thought that the tentacles went too far out everywhere in the world, and that if they went, it would just exacerbate the crisis. Of course, part of exacerbating the crisis is bailing out companies that should have been gone, like General Motors. So that's just my little bit of free market, no bailout talk. Take a look at AIG, which is having a bad week in here, and you can see as I switch this over for you that it's had a pretty big break and turning down. So you can see the cycle patterns in here, and that it has probably another couple of weeks on the downside and then probably move up again. You could see the way we have it drawn that we think it will fail after the next rally and then move more to the downside. Just for the fun of it, you want to see what the real AIG looks like. That's after the massive reverse split. You think you're looking at a stock that did well, that recovered well, right? Well, let's just put this over and look at a 20-month cycle. 20-month, there's your 20-month chart. If you look at the reverse split, the high in here was 2,058, and of course, after the financial crisis, they had a massive reverse split, and you have to come way in here to see what it looks like. But if I go way out over here, you can see what the realities are of this stock, as the stock should have been long gone, and this is really what's left of a very, very dismantled company that, like I say, shouldn't be here. Down 5% on the week as they had a bigger loss. Let's switch this back over to a 2-year weekly, and we'll take a look at a couple other stocks in here. NVDA, down 5% on the week. Now, this is a very, very nice topping pattern. The cycles in here are very long. There must be shorter ones in here, but I can't recognize them at this point because you need some reasonable lows to get that to get a good read on cycles, and you had nothing in here as the stock moved up from 30 to 120. So here's your shooting star, Haremy Cross, evening star, all of those things. They made the high kind of a double top right in here that was too far, too fast, and now in this corrective mode. It's going to probably come down another 2-3 weeks and then get a good buy opportunity. I actually have an alert set for me right over here because if it gets down to about 101, I want to be starting to nibble on the long side in this one in a couple of weeks because I think it'll pop up to 120 again when this correction is over with. So it's coming down to 13-week support. You could see right over there, which basically has held it through this whole time period in here. It's been just a monstrous moving average. We'll see if that one continues to hold it in here, but it has needed to take a rest. One more stock to look at in here and just make a comment on, UNH. Now, this to me, you see this gray area right here? That potentially could be a red area if you get a breakdown. Now, the news in here today is that the New York Times came out and some whistleblowers said that they have been overcharging Medicare for years. Well, you think it's bad news? Well, this is a disaster in the making, and I'll show you why. Here you can see this upward movement in here on the cycles. It follows this. In other words, the low is right here, and the low is right over here, and then the low is right over here, and then it rallied, and it's threatening to break down that low. If that's the case, this all turns red, and you decline here through May, and maybe that's some really bad news there in UNH. And of course, President Donald Trump is talking about threatening to put a lot of pressure on pricing. Interesting that there was a head and shoulders top in here, and the measurement got met today on the downside. Now, I'm looking at here at these shorter cyclical patterns, and it looks like another few days in the downside and an attempted rally. I think that this rally right in here, maybe in about a week or two, if that happens, is going to be a giant shorting opportunity. So this that we're talking about is the worst of the week, and I think that UNH very well may be one of the worst patterns that we're looking at for coming weeks or months in there if we get that breakdown. So keep your eye on UNH. That will drag down the rest of this group of the HMOs and potentially that whole category of HMO drugs, biotechs could be under pressure before you know it in here. So separate from this UNH, which might turn out to be something really important. So that is a look at our worst of the week. And what's coming up right now? Well, that's our short-term view for the stock market. I'll be right back. All right, here we are back with our short-term view for the coming week. Before I do that, I just want to remind you we're running a special. Now, you can have all of our 9 categories of videos, all of our setups, all of our rankings on the 81 best traded stocks, and our option bias ranking, which is just incredible. Try it for a month for half price, $43. It's incredible. And then you can really get a sense for what we do. Our option bias is just a way to tell how to direct your option positions, or if you're a short-term swing trader, you use it for that also. And we've recently started to add our orange arrows on our charts, which tell us where it's extremely overbought or extremely oversold, and these things are working tremendously. Wheat got extremely overbought just a couple days ago, reversed sharply. About a week ago, LVS got extremely oversold. It reversed nicely to the upside. So you don't have to have our charts, which are level 4, to see that, but it would to see it and really get a clear look at everything we do, all you have to do is just take our special to level 3, and you'll get all of that amazing analysis and all of our videos. So send me an email, slim@askSlim, and I'll send you that special link that lets you have all of that for half price. So amazing deal. All right, so what we do every week is we take an accounting of what we did the previous week, and when we do this for our members, we look at 5 major markets and look at all the momentum comparisons. In this video, we do the stock market only, and what we said for the S&P was that we thought it would have a dip and then move up again for the week. We thought that the upside resistance for the S&P 500 was in the area of 2323 to an extreme of 2333. It moved through all of those. And by the ease that any market moves up or down through support and resistances is how you tell extreme strength or extreme weakness. And we're certainly in a period, as everything I've showed you today so far, of extreme strength. So let's take a look here at the S&P 500, and we'll take a look as we move our charts in right now. And there you go. So here's the S&P 500, and it's been in this cyclical upward movement that you could see right in here. And 19 days, 20 days, and right now we're, oh, that's hidden right there, but that actually says 15 days. Let's just grab that right there and move it to, 12 days. There you go. So that's a 12-day peak that we have right there. And that was yesterday and a Thursday. And now here on Friday, we just have a day that's kind of eased back just a little bit and getting its usual late day pop. And this pattern in here is suggestive of the fact that over the next 5 to 7 days, you are likely to be in a downward trend. Now that downward trend says to us that because there's a small period of rally in here, we're looking for an attempted rally early in the week, but we don't think it gets anywhere. We're going to look for a failure in that 2350, 2355 area, and then coming down again. And we're looking for a test in the next 5 to we'll call it 5 to 7 trading sessions of this support area in the area of 2319 to 2324, right in there. That's that minor rising support and that 23.6% support right in there. So a little attempt to the upside in there and then moving to the downside. We think that it will be a relatively small down week, but this is probably going to be the week where you finally get some correction, where you get a down day that actually stays down. So normally what we do, of course, is we take our accountability in the following week. Next week, we're not going to be able to do that because we're off. Once a quarter, we take off, don't do videos, we do everything else. So those are our members in level 3 and level 4. You'll still be getting all of our daily updates, all of our charts on Thursday, all of that. So RV is still working at it, and you can write to me or RV if you have any questions, and then we'll be glad to get back to you. So we're still on task, but we produce no videos on that 1 week off that we have. So that's it. I hope that you have an excellent week while I'm away. Hopefully the market becomes more tradable, better two-sided action that we have seen in here. And it's definitely crazy out there. I want you to be really careful. And I'm always wishing you great trading.
Well, I'm going to the city.